Welcome to the Aul Financial Hour podcast with Steve Aul.
So how many keys do we have on our key ring? Well, do you know where they all go to? A poll by Easier Insurance found the average person has 9 keys, but they have no idea what 3 of the keys on their key rings are for. So when people, Steve, come to you for a second opinion, how often do they shrug their shoulders when you question them about a certain stock or annuity or something in their portfolio? And how do you help them eliminate unnecessary or maybe even unknown or outdated investments, sir?
I tell you, one of the hardest things for people to come in to sit down and with a guy like me and let us actually analyze where you're at is most of us have made investment mistakes over the years. And yes. I remember a stock that I bought back in the 90s and I was going to retire by 2000 with. And that stock's value today is 0. None whatsoever. Now, I could write it off and take it off my taxes. Do you know I don't? I leave it in my portfolio. So if I ever get one of those good ideas that somebody talks about, when I open up my portfolio to look at it, I can look at that one stock that I thought was going to do everything and find out some good ideas don't work. And I think that's the people that look at. I bought something, I bought a stock. I got an annuity a long time ago. Interest rates were low. It doesn't do a whole lot, but we don't want to show those. And I look at the 2 things that I believe are some of the biggest that times have changed that we want to look at. And a lot of it is the mutual funds within portfolios.
Yes.
Mutual funds were all we had when we first started in the 70s and the 80s. That's all we had because it was individual stocks and mutual funds. So if you wanted any diversification, you bought a mutual fund. That was all that was available. Well, today you have the ETFs, the exchange-traded funds. The internal cost of an ETF is much, much lower than a mutual fund. So I look at it and say, if the drag is less, why would I not go ahead and do that? So that's one of the investments that when I do see, people are shocked when I talk about the internal cost of an ETF and what the internal cost of their mutual fund is. So that's probably one of the big ones as it goes from there. I have to be a lot more careful when we get into the non-qualified or after-tax accounts.
Yeah.
Because if you move those, then there's tax consequences. But those mutual funds also have, if you have in a non-qualified account, phantom income taxes. Your value didn't increase, but you got income because they had to pay it out for their long-term, short-term capital gains, but your value stayed exactly the same. So you're paying taxes on trades that other people made.
Ooh.
I prefer to pay taxes when I decide to trade. Then you have the old annuities. Variable annuities, back, forth, the cost inside of all these things, people are shocked when they start to look at those things. And then they look at some of the more current fixed index annuities. Well, what are they basing their ability to pay you a capped rate? If interest rates are higher, the caps are higher. Well, if interest rates are lower, the caps are lower. Your participation is lower. Your income could be lower. Well, if you bought an annuity 4 to 5 years ago, when interest rates were low, you might be able to replace that thing now for a higher income with the exact same amount of money. I don't know. We have to do an analysis around stuff like that. That's when we do the annuity x-ray, where we're going to get the company that the annuity's with on the phone. We're going to find out what the internal costs are. We're going to find out surrender value, cash value, does it have a market value adjustment. We're going to give you all the information. Then we're going to look at it and say, does it make sense to keep it? Or would it make sense to possibly move it somewhere else? I like to look at it and basically say, I don't believe annuities are crockpots. You just don't buy it and just hold it forever. If something can improve it is there today, why wouldn't we look at it?
Right. And
why wouldn't we look at it?
Especially as much as interest rates have changed.
Yeah, so if you've got an annuity that's more than 4 to 5 years old, give us a call. Let's do that annuity x-ray. And if you're questioning your current portfolio and you're not sure how much risk you're taking for the reward you're getting, call now. Ask us for that risk-reward analysis. Give us the availability to sit down and talk with you about where you're at and what you could do for the future.
Well, the way to call, of course, is 636 636-230-8824. 636-230-8824. Book some time on Steve Aul and the Aul Financial Group's calendar there and get that annuity x-ray. Annuities have been a really strong way of late to try to not point as much toward the market and try to look more at different ways of more reliable income. And that's a good way to see if what you have is the right recipe, essentially, Steve, in that portfolio casserole for sure. Now, Steve, we also hear about the 4% rule of retirement. And it's over 30 years old. It's been a rule of thumb people have used for a long time. But new research by the American Council for Life Insurance gave it a stress test and found that it failed for older ages and resulted in the lowest income over time. So what could be used to help shield income against this market volatility and longevity risk, of course?
The 4% rule was a rule that was put together. You know, it had like an 85% success rate. Now, the question is, would you get on an airplane if it had an 85% success rate?
Yeah,
no,
really.
You probably wouldn't. So we look at it, and the thing that we have to do, and I would say Cindy came in, 65 years old, divorced, about $1.3 million in assets. She had income of about $5,000 a month, and her lifestyle was costing her $6,500 a month. So I'm going to guess there are people out there that your, quote, lifestyle is a little bit below what your current guaranteed incomes are. So what could we do? We could use a rule like the 4% rule and set aside money to give you that income. We could buy dividend and stock portfolios. Or we could look at it and say, how much money would I have to set aside right now so that I can bridge that $1,500 a month income if that was your case also? If it's $500, what would it take to go $500? If it's $2,000, $2,000. How much of your money could we set aside to give you a guaranteed income that you could turn on in a future date and go for the rest of your life? That way you don't have to worry about living too long. Yes, we're talking about a fixed index annuity with an income rider. It's an insurance company that's guaranteeing that. So if there's a gap between your living expense and your current guaranteed income, give us a call.
Now, Steve, we've talked before about delaying Social Security and how that can increase your monthly benefits when you decide to take it. Well, another reason to put off claiming is you might make more than the annual cost of living adjustment, which kicks in and compared to those earlier than at age 62. So for 2025, the COLA, cost of living adjustment, is 2.5%. Can you break down the difference? Is that difference big enough to factor in delaying taking SSI?
On that question there, I'm a nerd when it comes to numbers and stuff like that. 2.5% of $1,000 is going to be less than 2.5% of $2,000. I mean, that's just the numbers on that. So then we got the question of it is how do I go from taking Social Security early at age 62 to getting to 70? People don't realize that there's about an 8% increase per year for every year you delay when it comes to your Social Security check. So you start to look at that. That's a 76% increase between starting at 62 and going to age 70. Well, it's always easy to say, well, I'll just wait and take it till I'm 70. The idea is where are you going to get your money between here and there?
Yeah.
And that's why I say, a lot of people say, I'd like to maximize my Social Security. I said, why don't we just optimize it?
Hey, there you go.
And they look at me, well, what's the difference? I said, well, to maximize it, both of you wait till you're 70. That's the most dollars that you can get, but you got to live a long time to get that. People don't realize as a single person, if you start at age 62 or wait till you're 70, at between 80 and 81 years old, the break even is there. So if you're going to die before you're 80 to 81, take it as early as possible. If you're going to die after that, take it as long as possible. So we used to joke around, do you want to know the best time to take your Social Security? Just tell us when you're going to die, and then we'll be able to come in from there. Single people, that's how simple Social Security could be. If I don't need to take money out of my accounts. Married couples, completely different. Why? Because in a married couple, the lower amount of the two Social Securities goes away when one of them passes away. So if I'm the larger earner and my wife passes away, I keep my Social Security. My wife was the lower earner. She would get her Social Security and some of mine to get to very close to the amount of mine. So the survivor's benefit is so important when we talk about Social Security. And most people don't even think about it. I'm going to get mine because it's going to go broke soon, and I want as much as I can possibly get. Well, I would rather have them, if it's going to be reduced, which I don't think it will. I think they will work it out. It might not look the way it is today, but I think they will work it out. But I look at it to the point, one of the strategies that I probably use the most is the lower earner of the two. As soon as you're not working or hit full retirement age, turn it on.
Yeah.
Why? That lower earner, you have an annual earnings test, and if you make it, it's about $24,000 right now. If you make some of that, they will penalize you on your Social Security. The higher earner of the two, delay as long as you possibly can, hopefully to age 70. That's what I call like a split strategy, and I think that is the best for most people. And then when we start to look at, depends on what the differences between your Social Security are. And like I always like to say, I can't do it in a vacuum. I wish I could. I wish I could just pull it out of the sky and say, do this, do that. I have to do the full analysis. If I'm going to tell you to wait till age 70 to take your Social Security and you're going to retire at age 63, 64, 65, 62, whatever it is, I got to make sure you have got enough assets to bridge that gap. Yeah. And does it make sense? So if you've not already taken your Social Security, call now. Ask for that Social Security optimization report. Allow myself and my team to actually run those numbers so we can find out, do you have sufficient assets? What are your other income? And can you delay? We can't do it in a vacuum.
Steve, you have covered the gamut for all on this show for many different areas of a retirement portfolio. One way that people like you get paid is by charging an assets under management fee. All right. And that basically means, of course, for people that don't know, that people like you, Steve, get a certain percentage of the portfolio that you manage every year. On average, that cost is around usually 1%, according to Advisory HQ, but it might be lower if the balance is larger. And that might bring up the question, is this all worth paying a financial advisor the 1%? If someone comes to you with that gunslinger question there, Steve, how do you answer them?
I look at the fact that fees are fees. I don't do it for fun and for free. I get paid. You know, and that's why when somebody comes in and they do their summary of plan and I read that to them, my fee structure's in it. I found out very early I did not want to sit down with somebody, draw up an entire plan, have it all ready to go, and they're all ready to say yes, and all of a sudden they say, what's the fee? And I'm not the most expensive person in the world, but I'm not the cheapest either.
Right.
And then I find out, what are you getting for your fee? I think that's the question that most people forget to ask. If all you have is an investment advisor and they're coming in and they're picking, choosing, doing this, and they're seeing you once a year, don't ask me about taxes. Don't ask me about incomes. Don't do any of those other things. I'm just going to invest your money. That's all they're doing. And I look at it for myself. I don't charge extra for you to come in and look at those different things that I believe are necessary in retirement. You know, I like to look at it. What's necessary? A tax strategy. To talk to people about how they could, quote, reduce taxes for themselves or their children in the future. What about income generation? How are you going to replace that paycheck that you got in retirement? I always love it when people come in and say, well, my advisor said we'll just make you 6 or 7% and you can take out what you need. To me, that's not an income plan. That's just a suggestion. Social Security optimization. When should you take your Social Security? I think it'd be better to look at the numbers behind it than it would be just to say, I'm going to start today. Or what most people do. 10 years ago, it was 62, I'm going to turn 62, I'm going to retire, I'm going to take my pension and my Social Security. Now most people wait till they're 65. Could it make sense for you to spend down some of the IRA assets and push yours out to 70? I don't know. We have to run the Social Security optimization to give us the answer to that one. And then legacy planning. Are you going to leave a tax time bomb to your children? Or you're going to spend it down during your lifetime? I think those are the things that are doing, and I think that's what most people are looking for, other than just investment advice. So the question I'll put back, what are you paying your fee for, and what are you getting for it? I believe that we give people the things that they're really looking for, all under that same fee.
Thanks for listening to the Aul Financial Hour podcast.
Insurance products are offered through the insurance business Aul Insurance Group, LLC, AIG. Aul Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Aul Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and Aul Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Aul Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Aul Financial Group, LLC.
This radio show is intended for information purposes only.